You done? Oh. Oh, what? What's going on?
I said it started. You didn't start. I said we're going in 15.
No, you didn't. I heard Tennessee whiskey and all sorts of other jazz. And
Alright,
then
go
you
ahead.
went. And then you went dead.
Okay, go on in 5, 4, 3.
Bigsby, turn on Do Not Disturb mode.
Do Not Disturb is now on.
Let's see. Transition. There we go. What do you know? What do you know? What is up, all you market participants out there? Welcome to the Russell Journal. I am Russell, and this is my journal entry for October, what is this, Wednesday, October 5th, 2022. As you can see, I changed a few things about the journal today, and what we're going to look at is we are looking at oil, okay? We're going to talk about this first, and then we will get into some of the key things as far as like day trading and noticing things, okay? We will go through that. Big news this morning is that OPEC had decided to cut oil production by 2 million barrels a day. This roughly translates to about $10 per oil contract. I think it's per 100 barrels. It's between $1 and $2 per barrel. Having them cut 2 million. That was what my research said. We'll see. You can see the thing is this whole energy sector today basically saved the entire market. We were heading down. Okay. Coming into this morning, we had a jobs report. The ADP jobs report came out, and it was up 208,000, is 800,000 above created jobs or jobs from last month. So that's not good. Right now, if you're a bull, right, in this market, you're hoping for a Fed pivot, right? Going back to what we talked about yesterday, and if you didn't get a chance to watch yesterday's video, go ahead. It's on the channel. It's called The Loop. Go ahead and look back at it. What we have here is that if you're a bull, you need the cost of money to stop going up, right? And the reason you need that, or you need some type of respite in that, so you know where and how to average your positions, right? How much money you're paying per dollar of earnings, okay? This is what's causing these rallies in the market. And they make sense. They make sense if you're an investor managing your cost of money, right? If you are a retail normal somebody who is learning economics right now, you can't figure out why this is happening, why they think a Fed pivot is good, why they want a Fed pivot, why that's forcing a rally. They think that it's just It's just, big money is addicted to this QE type cocaine that they're giving you, right? So the thing is like the Fed pivot is really important to the bigger funds, okay? And you have to think about it from the perspective of the bigger fund, because they really drive a lot of the movement in the market. They're chugging tens, if not hundreds of billions of dollars around, and when they move that money, we all feel it, right? So the thing is what they have to do and what we think is being done is completely different. You are still in a bear market. You're absolutely in this bear market. And being in this bear market, right? These guys need to still move money around. And that means they're going to have to sell stuff and it means to buy stuff, right? Now, couple all of that with basic trading behaviors, which, okay, now this is one of the things we have to talk about a market principle here, okay? You have to remember, investors move markets sometimes, but most of the time, traders are the ones that move markets. Investors buy and hold for a long period of time. Traders, though, are the ones that are moving the market, okay? Now, when these big ships move, though, these big funds, it causes some stuff, okay? So if investors pull their money from one side and move it into oil because supply is going to be small and demand will still be relatively high, you can't fault them for that. And the next thing you have to understand is all of this, all the S&P, the Dow Jones, the NASDAQ, they are indexes. They're balanced out by all the different sectors. So if one sector does good, it's going to bring up the rest of the market. And that's the value of being able to buy the S&P. So one of the things I see a lot right now is a lot of like frustration from people who are buying puts that expire way too soon. And they're thinking this is all manipulation. Well, yeah, it is, because that's the point, right? If I buy it and drive it up and other people buy it and drive it up, and then the shorts have to cover their positions and that drives it up, right? If that's the thing, then so be it. Like that's what we're all hoping for, right? Like I'm hoping that Goldman Sachs shows up and wants to buy a bunch of stuff or sell a bunch of stuff, and I just happen to know about it or figure it out around the same time that they're doing it so that I can capture it, right? So today we have the market sold off on the ADP report of jobs. The Fed's not going to pivot, okay? Turned around, OPEC announces they're cutting production by 2 million barrels a day. Okay, this makes the energy sector more valuable, right? High demand, low supply, more money, right? Equals higher prices. Fair enough, right? And the energy sector makes up a portion of the S&P. So guess what? It's going to bring it up, right? So we will go through and look at all of this stuff as throughout the day. Now, what I really want to get into here is I want to talk about the keys to success in day trading, okay? And really where that is it lies within the concept of trends, okay? So I've put a few things, okay, so at the core of everything you do in trading, right, is not fundamentals, okay? At the core of everything we do is technical analysis and market structure. Market structure is the key, the number one thing. The only thing that can trump market structure is price action, okay? Market structure is broken down into a few things. Really, there's three. You have bull trends, bear trends, and no trends, okay? Those are the three biggest pieces of market structure that you will find, okay? So we will talk about all of our trends. Now, there are a few things that are in there that like you should know about. So for example, okay, if you're looking on this chart, You can see that I drew, okay, you can see this like missing piece right here. That's called a gap, okay? And these tend to get filled. So if you gap up here, typically what will happen is you will come down until that gap is filled, and then you will typically find a bottom. Or if you come down, it will come back up, okay, and fill the gap, okay? Now, there are rules for gaps, and I'm going to go over them probably in tomorrow's video. But for now, this is one thing I wanted to point out. This is one tiny piece of market structure. The thing you have to remember is the trend rules all, okay? The trend is more or less your God, okay? If you're small g, not, right? Okay, so we can look on this trend and we can see an absolute pattern of higher highs, higher lows, right? We've got higher low, higher high, right? You can see all of that, right? Right there. Okay, now there's a couple of things that are cool about trends. Trends can be your friend in that they will overlap, okay? As you can see, we had this trend coming across these tops and extending through the gap, right? And you can see we had this uptrend right here that broke. And when it broke, you can also see on the chart, we got a little gap down right around the bottom of right at the breaking of the trend. Okay. So there's some stuff we can put up. But the cool thing is where this trend ended, this trend picked up where that left off. Okay. So I'm going to get rid of these lines because they're not that important. They're just stuff I want you to be aware of and that we look for is these different variations in trend. Okay. You can get rid of this. And the thing that we're going to do right now is we are going to go to the 3-minute chart because this will be a lot more clear on 3-minute chart. And we're going to zoom in. And we're going to talk today about day trading. And we're going to talk about how we day trade. Now, a lot of guys have a lot of different things as far as different setups as far as what they use for day trading. But at the core of them, no matter where you go or who you talk to, the core of day trading is always the trend, okay? Remember, the trend is your friend until the end, okay? Now, what you can see here is I have drawn some lines on the chart, okay? And these arrows basically here point to different high spots in the market, okay? So we wake up this morning and everybody's upset. The market is coming down because the ADP report is bad. It means that the Fed is, there's still good jobs out there. And so the Fed is going to constantly raise the cost of money. Okay, we come down, we hit this low spot down here, and all of a sudden we get the announcement from OPEC. Okay, so the market does this thing, okay, comes down, creates this low, right? We now have a higher high and a lower low, okay? Or we have a lower high and a lower low, okay? You get to the bounce up here, and this is where you're free to go ahead and take a short position. You're fine as far as taking a short position goes here, right? Why? Because you have now lower high, lower low, still lower high, right? And you're free for this to come down and continue to make a lower low. Guess what? When it doesn't, when it turns around, goes back up and takes out your previous high and creates a higher high, now you have a new trend, right? You entered here off of the high. It came down, did not make a lower low. You either cut the trade because you thought it was not going to make it, or you held, let it take out the high, and that's where you cut the trade, right? And this is just what happens, right? That one particular instance is where you could have, you would have lost some money there. And I did lose some money there. I attempted this trade and that is what happened. But that's fine. That's what you're supposed to do. Guess what happened though? We came up, we made a higher high, we pulled back, we made a higher low. I entered here and we rode this all the way back up. Okay. So the thing is like, now the cool thing is with your trade, you enter here, you get up here, you can set your stop anywhere between here and here. Okay. So that wherever it pulls back to, if it turns around and just goes south on you, you lock in some profit. Okay. So the key here is market structure. And guess what? If you missed the first move, you could have caught the second one. If you missed the second one, you could have caught the third one. If you missed the fourth one, you could have caught the this one, right? So you really had all of these opportunities to trade as long as you were comfortable setting your stop loss. Now, it could have turned at any point and you'd have had another situation like you did with your short down here, but that's fine. You're only taking a small loss. Whereas, right, like you're only losing basically this much of your trade. And then if you had traded this, you would have made that much, right? So that's how much space. Now, again, this is all like I'm keeping a lot of the money, the dollar, the actual levels, because it's all arbitrary. Tomorrow, it's going to be at a new level, doing a new thing, having a new trend, okay? And this is where we start to look at stuff and go, okay, this is the trend. This is how we trade the trend. Where things change for the trend becomes not with just the trend itself, but with the price action. Okay. So we're going to go and I'm going to get rid of some of this stuff. Oh, there's a couple of things. One, I did put this dotted line right here. Where is it? Yes, the dotted line right here. One of the things I wanted to be clear is how come this one came up, touched down here, got up, the next high was here, and the next low was here. How come it went up and pulled back only to here? How come it didn't come back to this arrow right here, right? And that has to do with this thing over here. This is a breakdown area, okay? So when we got below it and came above it, it became a breakout area, okay? So what it had to do was find support at this area to negate this area. And it gave you then the move. When you had support, it gave you the move away from the breakdown low over here. Okay, breakdown area. All right. So the thing is like you are free. This is the only place in here where you probably could have set an entry and been fine, right? As far as like setting your entry goes, on a low that is not touching the previous high. Okay. But this is picture perfect. Okay, now what we're going to get into next is the next part where, again, we start to trump things out, okay? And this is where we begin to look at price action, okay? Now, this is something that is going to be really difficult to demonstrate without a live chart going, okay? The thing is you came here, you got the break above, now all of a sudden you put in a higher low and a lower high, okay? You are now devoid of trend. So what do we do? How do we trade this, right? And sure enough, lower high, higher low, lower high, lower low, right? This is our new trend. What a new trend. Why wouldn't you short that? Oh, look at the price action. Look at the way the candles are just flying green. Sure, it's not trending. It's grinding maybe. But our price action here is telling us that the trend is changing, right? That it's shifting, that it's doing something different, okay? And the thing is like, this is where we begin to go, okay, what do I do, right? Now, when this happened, I got out of my trade like right in here because I was like, that is some bearish price action, right? And this is some profit taking and some other stuff. There is some pressure in here that is keeping this from continuing this movement up like that. This whole thing here is believe it or not, that is, even though it's bullish price action, it's still sketchy, right? And so it's time when we got up here, we got into the upper Bollinger Band here, and I took profit, okay? But the thing is like, and the thing is funny is had I keep waiting, right? Now look, I keep waiting. I get up here and we have this move all of a sudden way back down here. Now I lose all of this. And this is what I'm saying. Like the price action is getting sketchy. Yeah, it's bullish, but it tells me not to short it. But it also tells me it's getting time to get out. Okay. The second thing about this that is interesting, and this is another piece of market structure, is the wedge. Okay. I'm gonna go ahead and delete these things really quick. And because I want to paint this picture of the wedge really fast, and what I want you to understand about the wedge. Okay. Because there's two types of there's a few types of wedges that you get. Okay. So we're gonna go to a longer time frame just so you can see it a little easier. Okay, so you can see right here. I'll show you. Okay, so you can see right here, the candles come up here and they press against basically this line and they can't do anything. Okay, but at the same time, you have this sort of thing happening where and I don't even want to do that. We can just take it from here. You have this thing happening here where they're coming in and buying it at higher lows, okay? And they're pushing it up. Now, what you typically seem to think is that we're going to push up against this level right here, right? And that we're going to push up against this level right here. And this is commonly, this is what we see as like a breakout wedge or a bullish wedge, right? Now, they have two patterns. One is they do this, they push up, and then they just go straight up. They get over that level and they just go up. But more commonly, you will see the pattern that is actually on the screen right here. And what you will have happen is it'll push up, it'll fail the breakout, it'll come back, retest support, and then rocket up over, okay? Now, again, it doesn't mean it's going to every time, but usually if you're pushing up against here, it fails, you want to cut the trade, but you don't want to flip short. That doesn't mean you want to flip short. What you want to do is find a zone like this where you could get a bounce from, because that is typically what you see is like this, but then you get this move and then the rocket up. Okay. This is referred to oftentimes as the pullback. And this is the second piece of market structure, right? This is, you've got your trend, higher highs, higher lows, right? Higher highs, come in, create that higher low, and then push for the higher high. Okay. Again, this one is really, it did fail. This is a failure of it. But this is the key to this, right? Now, you can take this and couple it with momentum, right? We can see here where if we had played momentum, we had seen the bounce here off of oversold. We could have ridden this all the way up here, right? Held it. When you finally gave up the overbought reading, that's where you could have taken your profit, right? Pull back with our momentum, comes back up through oversold. This is where we place another entry, and we know to be long because our market structure is a bullish trend. Okay. So when we're doing our technical analysis at the end of the night, there are a few things that we want to look at. We want to look at them. We're trying to figure out what's the market structure. Okay. That's why the first question is, what is the trend? Bullish or bearish? Okay. The next question is always, what's the trend? The next question is, what is the bias, right? Now, currently, SPY is trading exactly at the 18 DMA, which we will go ahead and get rid of some of these lines, and we will go ahead and do our normal study, okay? So we're going to keep our gap, our red gap thing right there, but we will go back and do our normal study, okay? So that we understand. We have our market structure, okay? And I'm going to zoom in so it's more clear, okay? Now, the cool thing about this is when you talk about this or think about this, you really only need 3 to 4 points on the chart. You don't need to go back through all of this stuff and be like, well, what's it going to do? Is it going to follow that? Right? a lot of this stuff lines up just coincidentally, right? A lot of the stuff kind of happens because the some of it moves based around the averages, some of it moves based around the Bollinger Bands, but mostly it's just coincidence that it ends up at the same thing, right? Because numbers are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, right? They're going to line up with that crap. It's just going to happen. So there's not something overall magical about most of these zones, right? There is some stuff that we will go over when we talk about different candles. I am going to do an episode all about the different candles, and we will break those down. But for right now, we're talking about trends today. So we're looking at the trend. So you tell me, that is a lower high, that is a lower low, that is a higher high. And until further notice, this bad baby is a higher low. It's below this one. It's got a bottom down here. Your trend is now turned to bullish. Your market fundamentals don't support that, but that's what you got. Second of all, okay, so now if our trend is bullish, we're thinking we need to be bullish, right? How do we confirm that? We confirm that with the 18-day moving average. Are you above or below that average? This dotted line right here is 18. Okay, we are currently below it. Guess what our bias is? Short. Does that mean we go short? Maybe not. We might need to see some stuff, right? You've got a bullish trend and a short side bias. In the meantime, what's our momentum doing? Oh, it's going up. So guess what? 2 for the bulls. We've got momentum up, trend up, bias is down, right? Crazy question then. How then do we continue to decide? Does the 18-day moving average really decide all of that for us? Let's talk it out. And this is where, like, maybe, and this is something I'm working on, is an idea of like a straddle play, or what some of them call it a strangle. Okay. All right. Trend is up. Bias is down, but momentum is up. Okay. Now, one of the things we may be able to do here is buy a put and a call, both at the money right here. Whoever wins the day wins, right? So that's kind of what I'm thinking going into tomorrow. If we stay right around in this zone, might be puts and calls both sides, okay? We have not seen a complete rejection of the 18-day moving average. What we would really like to see in order to trade this is a move up above it, okay? We'd like to see a move above the 18. And then what we would like to do is see it move back down underneath it, okay? Or one of the things that we would really like to see is just a straight rejection of the 18-day moving average. Now, one of the things that you will need to keep in mind, this is a moving average. So whatever the average of today was is going to move this thing down here. So starting out tomorrow, you are already going to be underneath the 18-day is going to be underneath you. Whatever happens tomorrow, you are automatically going to be underneath that. Okay. So again, should you be holding a position right now? Absolutely not, unless you are just straddling this. And that's fair. One up, one down. That would be a fine move. Cut whichever one is losing, ride the other one into whatever Bollinger Band there is. Okay. So this is where we go. All right. So now we've been through all of that. We're going to go through the regular mix of things. All right. Your VIX is starting to change. Okay. You are now getting into a weird place where you do have a pattern of lower highs and lower lows. Lower high, lower low, right? Our trend is down. Our bias is still up. It is over the 18-day moving average. Momentum is down. Targets down here at the lower Bollinger Band, okay? risk to reward right here. Woo, this should be easy for all of us, right? The thing is take a short position here. If it gets above one of these candles on the daily, cut your short position. It didn't work, okay? But for the most part, a short position on the VIX should technically be pretty easy. Look for a break below the 18, and then that would be good. Now, what I will say is the fact that we're not catching a bounce here, little iffy. I think that there will be a bounce right in here somewhere, a real bounce. I don't to look for something that sets in like a lower high. I would say it'd be probably better if you do want to take a short position for this to make a higher or lower high and then be able to cut it, like something really distinct. Right now, the VIX has not got a distinct setup on it as far as that goes. DXY. Now, this is what I was talking about yesterday and the day before, okay? You came down, you broke below the 18, and now you're trying to get back to the 18. The dollar doesn't know what's going to happen, right? And have the dollar and the SPY make a move like this, similar to this, on the same day, little iffy also, okay? So watch out. Tricks and traps and fools and all that sort of stuff. Trick and Company is working today, you know? Okay, so trend down, bias still down. You've got to bounce, but you're still down, right? And then the momentum still down, right? So here, look for some sort of failure around this spot. If you get a move above this and keep going, it will probably mean that the market is also going to continue to go down. We will see. These two are the three I pick that we do analysis on all reflect on each other. They all have an effect on each other. Okay. So that is all very good and well. Okay. Again, we will go through SPY really fast just for cause. Again, trend is now up. Bias is still down, right? This would technically be non-trade. Trend up, bias down. Don't trade it, right? You have got momentum up, okay? And possible price targets for this are, again, if you reject here, the lower Bollinger Band on the daily, and if you go up, then the upper Bollinger Band. Price target of 408, and below that, 351, okay? So you could probably straddle this pretty easily for next week. Probably just buy the band, you know, see whichever one pays out. All right. So with that being said, I am going to go back over here and do this. All right. I'd like to thank you guys all for joining me today. If you didn't catch a chance to check out yesterday's video about the doom loop, this is exactly part of what we're talking about. With the Fed is going to raise rates, lower rates, raise rates, lower rates. Okay. And then if you can, do me a favor, give me that like and subscribe. Really trying to 100 subscribers. I got 60 more to go. Please, that really helps the channel out, helps the algorithm get me out there and get into the conversation around stocks. And then, yeah, so I really need that like and subscribe. Give me a share, ask your friends to help me out. Do me the favor. I would really, really appreciate that. So the Russell Journal is written, edited, and hosted by me, Russell Liss. We are produced by Social Media Shows. Our executive producer is Maria Pureza. She's a wonderful lady. Go check out Social Media Shows if you get a chance. And until tomorrow, you guys just pretend I said some sort of catchphrase.